This is how I'm generating over $1,115 a month in passive income using just three Canadian ETFs with an amazing 12 to 14% yield. While everyone else focuses on traditional dividend stocks yielding 3 to 4%, the reality is there's a category of investments designed specifically for income that can triple or quadruple those returns. And the best part, they're actually outperforming the S&P 500 when you reinvest the dividends. So what are these ETFs? I'm using HMAX, UMAX, and HYLD, all from Hamilton ETFs. And trust me, I didn't just pick these randomly. I compared them against every reputable high dividend ETF in Canada, looking at total returns, consistency of payment, and sector exposure, and management quality. These three ETFs fit perfectly for what I was looking for: consistent passive income that doesn't need constant babysitting. These funds all use what's called a covered call strategy. And without getting too technical, this strategy generates extra income beyond regular dividends, although it does limit your gains if markets really take off. The huge benefit is that they all pay monthly dividends, perfect for anyone wanting consistent cash flow. Now, let me break down each one so you understand exactly what you're getting. So HMAX invests in Canadian banks and insurance companies like RBC, TD, and Scotia. It's given me around 13.7% yearly yield and 11% return since inception when reinvesting dividends. The fee is 0.065%, which is higher than some index ETFs, but reasonable given the active covered call management. UMAX focuses on Canadian utilities, pipelines, and telecoms. Think Enbridge, TELUS, and Rogers. This one's yielding around 14.3% with 8.7% annual return since inception, 0.65% in fees as well. I particularly like this one for the stability during market volatility. Then there's HYLD, which targets US stocks similar to the S&P 500, yielding about 12% with 5.7% return since inception. Now, what's cool about HYLD is that it actually holds other ETFs like SMAX and QMAX, which each contain their own mix of US stocks. So just by holding HYLD, I get great S&P 500 coverage without complicating things. So to see exactly how these ETFs could generate passive income for your specific situation, check out the free investment profit calculator in the description or the first pinned comment. It'll show you precisely how different investment amounts could create monthly passive income based on your timeline and goals. Now, here's the thing. I don't recommend this approach for everyone, but this simple 3 ETF approach works perfectly for my busy life. Between my main investment portfolio, my marketing company, and my 2 kids, I needed something that wouldn't add more complexity. And this setup was perfect for money that was literally just sitting in my checking account doing absolutely nothing. I was either going to use this strategy or I was going to place it in a high interest savings account or a GIC. So don't just copy exactly what I do. Use these videos to help build your own strategy based on your own personal goals and situation. Now, let's look at the actual numbers compared to something more traditional like XEI. So if you put $100,000 equally into HMAX, UMAX, and HYLD, and on a side note, I put 70% into UMAX, 20% into HMAX, and 10% into HYLD. But for simplicity's sake, let's just use an even split. You get Canadian exposure to utilities. You get US stock exposure with an average yield of about 13.38%, giving you roughly $13,380 in annual dividends. That's $1,115 monthly. Compare that to traditional dividend ETFs like XEI. That's 5.4% yield, 0.2% fee. That same $100,000 would give you around $5,460 in annual dividends or $455 monthly. XEI's total return is different though, typically around 7% with more coming from price appreciation. And you can calculate these returns once again using that free profit calculator in the description or first comment. The key trade-off is that XEI gives you less immediate income, but potentially better long-term returns, while my covered call strategy gives you significantly higher monthly cash flow, but might underperform in strong bull markets. And the one thing people often miss about covered call ETFs is how they affect the net asset value or the NAV over time. In simple terms, by limiting the upside potential, the NAV might grow more slowly than with traditional ETFs, especially in strong markets. Some of the dividends might actually be return on capital rather than true income. There's also inflation to consider. If these ETFs grow by only 1% in NAV, while inflation runs at 4%, I need to reinvest 3% of my distributions just to keep up. This reduces my spendable income to 13.3% to around 10.3%. On $100,000, that means setting aside around $3,000 of my $13,380 annual income, leaving me with around $10,380 or $865 monthly, but that's still way higher than XCI's $5,460 though. But that difference isn't quite as dramatic when you factor it all in. So who should consider these covered call ETFs? Well, they're great for retirees needing immediate income, investors like me who already have growth investments elsewhere, and people looking for alternatives to fixed income, and anyone with a time horizon under 10 years. They're probably not ideal for investors focused mainly on growth, very conservative investors, or people seeking super simple, low cost solutions. The pros are pretty compelling though. Much higher monthly income, regular payments for easy planning, potential reduced volatility, and competitive total returns when reinvesting those dividends. But there are definite cons: limited upside in bull markets, higher fees, potential NAV erosion over time, more complex tax treatment, and sector concentration risk. Many people find success with a blended approach, maybe 50 to 70% in broader market ETFs and 30 to 50% in covered calls for boosted income. That gives you a more balanced profile while still increasing your overall yield. Personally, these covered call ETFs are less than 10% of my overall portfolio, but if I were retired, they'd probably make up at least 60 to 80% since I could live off the dividends and reinvest whatever I didn't use each month. And remember, investment strategies should fit your specific situation. These covered call ETFs work well for me right now in 2025, but your ideal strategy might look completely different. The most important thing is understanding exactly what you're investing in, including the trade-offs that come with higher yields. All right, watch these two videos for more investing tips. Bye guys.